Hello and welcome to Growing Your Business by the Numbers, a three-part series. I'm Julie Cranston, Director of the SBDC at UCI Applied Innovation, and I'd like to thank you so much for joining us today. Today's webinar is brought to you by the SBDC at UCI Applied Innovation in partnership with TGG Accounting. The SBDC is funded in part by the U.S. Small Business Administration and the state of California. The SBDC is here to help you start, grow, and succeed in your business by providing no-cost expert consulting and training such as this webinar. In addition to our regular consulting on business management and equity funding, we also have been helping our small business clients understand and apply for SBA loans like the Economic Injury Disaster Loan, or EIDL program, and also the Paycheck Protection Program, or PPP loan. We can also advise on how to administer these loans if you receive them, so make sure to reach out to us if you need assistance. We have a hotline set up and additional resources available. The hotline number is 1-800-616-7232. That's 1-800-616-7232. And if you're a tech or life science business, you can go straight to our intake form at sbdctech.org/contact. We also have a COVID-19 resource guide available at ociesmallbusiness.org, and we'll put all this information in the chat feature. A little housekeeping before we begin. Everyone is muted during the webinar. Tomorrow, the recorded webinar and a PDF copy of the slides will be sent to all participants. There will be Q&A at the end of the presentation, but please feel free to ask questions during the webinar by clicking on the Q&A box at the bottom of your screen. We may not get to everyone's questions, but we will do our best. If we don't get to your questions, please email hkhaled@fullerton.edu, and we will attempt to answer them and get back to you. Our program today will be presented by Matt Garrett, founder of TGG Accounting. Matt is an entrepreneur who found out about the power of proper accounting and excellent financial management through the sale of his previous two businesses, one unsuccessful and one extremely successful. He aims to share those lessons with people to empower them to achieve financial freedom and peace of mind. In 2006, Matt founded TGG, an outsourced accounting and business advisory firm. He started the firm to deliver financial information to small and mid-sized businesses to dramatically reduce the business failure rate. Matt is a regular speaker across the country on behalf of Vistage, educating business owners on the need for sound financial practices. He received his BS in Human and Organizational Development from Vanderbilt University. Matt, thank you so much for being here today. I will now turn the program over to you.
Great, thank you very much, Julie and Hannah, and I appreciate the opportunity to be here. We're going to talk about the super sexy topic today of entity structure and entity formation for entrepreneurs and what you need to know about this. And what I'm actually going to do is actually give you some to-dos and some things to think about when it comes to entity structure. We're going to talk for about 35 minutes, and then it's going to be more interactive when you're taking your questions and answers so that hopefully we can tailor this to actionable items and takeaways that you can have to make your life better as you move forward in your business and with your business career. So again, thank you, Julie. Thank you, Hannah, for doing this. I am Matt Garrett. I'm the founder and CEO of TGG. We're an outsourced accounting firm. What we do is provide numbers to business owners so that they can make good decisions. And we're usually 40 to 60% cheaper than hiring full-time in-house. So that's the business we've built and the services that we provide. So let's just start to talk a little bit about what it means to be a business owner. Because to me, being a business owner is probably one of the most important things I've done in my life, next to being a father. And it's one of these things that I take a tremendous amount of pride in. I employ a lot of people, and that makes me feel really good because we've been able to create a structure, and with their help, I've been able to do something that I could never have done on my own. And so it's being able to take an idea, take a concept, having the courage to move out there and do something with it, employing people, building a team, really organizing folks together so that ultimately you end up doing something that's really impactful in the world. And for us, and for what it means to me is looking at this team and saying, all right, what are we really going out there and achieving? And this is a picture of me and my team. And for us, it's been about business failure rates. And I know that's sort of a negative way to look at it, but according to the Brookings Institute, 1 in 12 small businesses fail every single year. Only 50% will make it to year 5, and only 33% will actually make it to year 10. So this is a big problem in our country, and particularly now with everything that's going on with the economy and the world around us, there's a lot of uncertainty. And so what we want to do is be able to provide numbers that people can rely on. And what I take a ton of pride in is not just employing people, but that the work that we do serves a community. Because in the last 12 years, we've only had 4 businesses fail or go out of businesses out of 500 or so that we've worked with. And so that's a lot of pride. And when you're thinking about your business, think about what problems are you solving? What good are you doing? Because the mission has got to be greater than yourself. And the people that you bring in really make a big difference in ultimately how successful you are with that business. It's not just again, so we're going to talk about entity structure today, but I really want you to think about the entity structure as just an extension of the culture that you're really trying to build and really an extension of the mission that you're trying to do. And so for us, it's all about bringing in the right people, partnering with the right groups, and making sure that ultimately we figure out where we're going with this business and setting goals. So when you think about a business, the first thing that a business needs to start with is a vision. Where is this vision going? Where is the business headed? What are you doing? For TGG, our vision is to be the nationwide source for financial health for small businesses. Everyone in the organization knows it. That's the vision. From then, you're going to go into the mission. The mission is really why you're doing what you're doing. Our mission is to make business owners' lives better through excellent financial management. From there, you want to talk about strategy. How are we going into doing this? What's the strategy that we're going after? For us, it's really about expansion, but slow, steady expansion. And through COVID, we've actually learned how to work remote and do some other things that are pretty neat. So the strategic implementation of that then goes into tactics. And then those tactics end up as results. And we measure those results and we go all the way back to strategy, adjust the strategy around and move. But the vision and mission should really never change. And that's what's so neat about a business and how you're setting up your goals for the future. So what does this do, or how does this work when you're thinking about business structures and setting up business structures? We've got all these different structures: C Corps, S Corps, LLCs, partnerships, sole proprietorships. Some of them have advantages. Some of them have disadvantages. Actually, all have advantages and disadvantages. But for you, I want to help you pick one today that's going to suit your business vision and mission, the two things that really never change in a business over the long haul. So we're going to talk about all of these things. We're going to talk about how you can get different businesses may need investment and what are the best businesses to get investment. We're going to talk about working with different partners, employees, bringing on employees as owners, all the different limitations and opportunities that you have with various types of businesses, because there's a lot of different, kind of words out there. So just to be clear, I'm not an attorney. So I don't draft documents. I don't do any of these things. I just help people figure out what is the right sort of structure for them. And the first thing that you want to think about is flexibility. The next thing you want to think about is control. Third thing you want to think about is taxes. The fourth thing you want to think about in all of these is liability protection. And the fifth thing you want to think about, I said flexibility, is investors. Do you need investors, and what kind of shareholders are you looking at in the future? So we're going to start with the basic C Corp. This is the original sort of entity structure in our country, and it goes all the way back to the English system and the English feudal system, where they created this thing called an alter ego. And what that means is that your business is not you. And they created this typically when they were going and doing the privateering, and they would say, look, if the ship is lost and we have liability, I don't want personal liability. I don't want anybody to be able to come and get my stuff. And so they created this entity and them, and that's called an alter ego. And that's the term of law that really created the corporation. The first corporation we've had in this country really established lately is the C Corporation. And a C Corporation is a company. It requires a corporate document and it has shareholders. And the way that it works is effectively there are virtually no restrictions on any kind of shareholders. You can have different classes of stock. You can have voting, non-voting. You can have preferred stock. You can have common stock. You can have stock that pays a dividend. You can have stock that doesn't pay a dividend. It's pretty wide open as far as what you can do. The challenge with the C Corp is when it comes to taxes. So first start with flexibility and ownership, but then taxes. The tax problem is that on the federal level, it's got a 21% tax rate, but in California, it's got an extra 13% on top of that potentially, anywhere from 9 to 13. So if you get to that point, you're already paying 34, 33%. And then you want to take more money out of it as an owner, you have to take it out as a dividend because the C Corp is its own tax-paying entity. So now we're going to take the money out as a dividend. It's anywhere between 15 and 20% tax on that. Now you're up to paying anywhere from 45 to 55% tax. You've got double layers of tax. And it's even worse when you go to sell the company. Because if you go to sell the company, you're going to typically sell assets, and those assets are going to get sold. The company's going to have capital gains tax, and then it's going to have to give the money out to you as a shareholder, and you are again going to pay dividend tax on that. So whenever you hear the term double taxation inside of a C Corp, that's what people are talking about. Very important to understand that. So really, there's only three ways to get the money out of a C Corp. One, you can take it out as a loan. 2, you can take it out as a salary, which is always income taxed and has all of the payroll taxes associated with it. Or 3rd, you can end up taking dividends out of it, which are going to have dividend taxes on them. But here's the good news. With a C Corp, you can have as many partners as you want and any kinds of partners if you want. So if you're looking to get investors that are foreign investors or corporate investors that are coming from a corporation or a fund, something like that, a C Corp might be a good structure for you, and it's something to think about because some of the other structures are a little more limited. When it comes to liability, this was another big point that I was making about things that you need to think about when you're talking about corporate structure. The C Corporation has protection of liability for its shareholders. So this is great news because, again, you don't want to get personally sued if the corporation does something that's a little bit weird or that you get sued for. So that's the whole reason for setting these things up. The next type of entity we want to talk about is something called an S Corporation. An S Corporation is nothing more than a C Corporation with a tax election. So all of the liability protection that you get with a C Corporation is identical to the liability protection you get with an S Corporation, but it does have some differences. First and foremost, you're only allowed to have up to 100 shareholders. That's not a terrible limitation for most people unless you're going to go public. The real limitation comes in is that the shareholders have to be individuals and they have to be citizens of the US. So both of those are pretty big limitations if you're trying to get foreign investors or if you're trying to get funds to invest in an S Corporation. What's the good news though? The good news is there's only one layer of tax. Only one layer of tax. You still have the same stock certificates, you still have all the stuff you have, but you have only one layer of tax. So you're only paying tax like you would if you were into a partnership or an LLC, which we're going to get into here in just a second. So what's the good news in that? The good news there in an S Corporation is what you can do is you can limit the amount of salary you have to pay yourself. It has to be reasonable, but you don't have to pay yourself all the earnings out in salary because you don't have to worry about a double dividend tax. You can pull out what's called distributions. And when you pull out money on distributions, you don't pay any payroll taxes with it. And you're only paying income tax on the income that the S Corporation actually generates. So this is really important when you're taking money out of a business because an S Corporation, you can loan yourself money, but you don't have to. You can pay yourself payroll, but you only have to pay a reasonable salary. And the remainder of the money can come out as distributions. So you're really minimizing the tax. And in California, though, we do pay a net profits tax on S Corporations. And so that net profits tax is typically around 1% of net profits and something to consider as you're moving forward. And it's unique to S Corps. However, like I said, you really want to make sure that you're thinking through what kind of shareholders you want because you have to make sure that you've got the right structure to be able to take on investors if you want to. And typically investors are not going to be able to invest unless they're individuals inside of an S Corporation. Last but not least, though, I want to reiterate, an S Corporation is nothing more than a C Corporation from a liability standpoint. So liability is identical in an S Corp and a C Corp. The corporate documents are the same. All the maintenance of the documents is the same. By the way, all of these require annual maintenance, annual meetings, keep these things up. If you don't keep your corporate structures up, and this is a big warning, you want to write this down. If you do not keep your corporate structures up, you may have personal liability if something happens. You actually have to act like you have a corporation and treat it as though it is a separate entity from yourself. The next thing I want to talk about is an LLC. And LLCs are relatively new. They're only about 30 years old, 40 years old, believe it or not. And an LLC is the same thing essentially as a partnership and a C Corp if they crossed. So an LLC is almost the most flexible of all of these. There's really only one downside to an LLC, and I'm going to say it right up front. And the big downside to an LLC is that in California, we pay a gross receipts tax on LLCs. So up to about $12,000. So what that means is even if you're not profitable, you still might owe tax on your LLC on an annual basis. Now, that's the big negative. We got that out of the way. Let's talk about the positives of an LLC. In an LLC, you can have all sorts of different shareholders. The shareholders, however, in an LLC, just a technical term, are called members. This is important because it's different, because you can have two different classes of members. You can have regular members that are like regular shareholders. They don't really have a say in what's going on. And then in an LLC, you have managing members. And those managing members are members that actually do have a say of what's going on. But you do not have any maximum number of shareholders that you have to have. You can have different classes. You can treat them all differently. You can have preferred and non-preferred. Some can get preferred distributions over others, all of these sorts of things. And the great benefit of an LLC is that you can elect to be taxed just like a partnership or just like an S corporation, which means only one layer of tax. This is great news because, again, you can get away from some of those distribution and double taxation issues. However, this is important with an LLC. If you are an owner of an LLC and you are an active participant, you are going to be paying self-employment taxes on all of your share of the earnings inside of an LLC. So make sure you're mindful of that, because it's not just like an S corporation where you can take the distributions. If you're an active participant in an LLC, chances are you're going to have payroll taxes with it. The good news again, though, is you can work with multiple partners and you have these company agreements that can get very, very flexible. An LLC, in my mind, is almost the most flexible vehicle you can get. So if you're taking outside investment from individuals or foreigners or corporations or funds or whatever it is, you can take them from anywhere. And that makes an LLC a great starting point for a lot of people. The other thing is that an LLC has just as much legal protection as a C Corp or an S corporation. So in terms of that alter ego thing we were talking about at the very beginning, you have just as much legal protection. And that's really great news because you can be separate from your LLC. The only challenge here is that there is some liability. For example, in the new law that was passed last Friday, signed by the president last Friday, that updated the laws on the PPP, they're allowing for you to defer your payroll taxes out. So you can defer payroll taxes all the way up until I have to pay 50% of them December 31st of 2021 and another 50% December 31st of 22. That sounds great on the surface, but in an LLC, if you don't pay those payroll taxes, chances are you are going to be personally liable as the owner for those payroll taxes. So you've got to be very careful. There are some things in an LLC where you might have some personal liability on debts, for example, payroll taxes. Very important thing to consider. The other thing now is we're sort of sliding down the scale here in terms of different types of entities is a partnership. Now, a partnership can form in a couple of different ways. It could just be two people sitting at a coffee shop saying, we want to do business together. And that's called a general partnership. And a general partnership doesn't really even require a partnership agreement. It could just two people shaking hands. That, in fact, is a partnership. But what we really want to think about is most common partnerships, which are limited partnerships. And limited partnerships have two different types of partners. They have a general partner who's the one that's in control and has all of the liability. There is no liability protection for a general partner. And then you have the limited partners. Think of the limited partners as shareholders. If you or I were shareholders in Microsoft Corporation, we don't have any liability for the work that Microsoft is being done. That's similar to a limited partnership. If we're limited partners, we have no liability, but we also have no control and we don't have a say, no voting rights for limited partners. This is interesting because we find these limited partnerships typically in real estate type things, or where you have a general partner who's raising funds from outside people to go do oil and gas developments and things like that. But they want to pass through all the income or pass through all the tax benefits to the limited partners, but they don't want any liability. This is typically where you'll find these partnerships. And income is for the most part distributed pro rata, but it doesn't always have to be. And it can be stated in the partnership agreement how that all works. So again, a partnership is not that different from a C Corp, not that different from an S Corp, not that different from an LLC, except for the fact that there's only two classes of partners, a general partner and a limited. And the general partner, believe it or not, still has all the liability. Limiteds do not have liability. The great news about a partnership is it's just like an S Corp or an LLC, where there's only one layer of tax. It's not taxed twice. And so you really have a lot of tax leverage in there. And then you can have just about any kind of investor you want. So it's not like the S Corp where it's got limited investor potential. It's more like the LLC where you can have any kind of investor you want in there and no problems there. The last thing here that we're going to talk about as we go through this is a sole proprietorship. This is the last type of an entity. A sole proprietorship has no legal liability protections. So if you're a sole proprietorship, what you're doing is you're actually filing your taxes on a Schedule C. This is just an individual out there doing business. This could be a 1099 driving for Uber. It could also be someone who's actually setting up a legitimate business. The great news here is there is absolutely no distinction between yourself and your business for tax purposes. Everything goes on your Schedule C, but that means everything, all of your income is also subject to self-employment taxes. So you've got to be very careful because a sole proprietorship, if you're running a business as a sole proprietorship, you truly have full liability. And it's really just money in your pocket. So as you're walking through this thing, your business is going in, cash is coming in, cash is going out. That's all your cash. There's no wall, there's no alter ego there of the stuff that we talked about before. And what we found in some of this stuff, like with the PPP loans, people had a very hard time if they weren't taking a salary, showing that they had income so that they could qualify for these kinds of things. So you've got to be very careful. It's just a person, just an individual, no multiple owners, but also no legal protections. All right, now let's talk about this. You've got a pad and paper. I want you to write down, there's a handful of questions that I want you to ask yourself when you're starting to think about what type of an entity do I want? And the first question that has to be answered is, what is your vision? What is your goal? If your goal is to get a huge, huge business, grow extremely fast and go public, you probably want to be a C corporation, or maybe an LLC at the start that converts to a C corporation. Second thing that you want to think about when you're going through this, so past the vision, is what sort of legal liability do I have in my business? Chances are, if you've got a typical business, you do not want to be a sole proprietor. You want to have some alter ego. You want to have something set up that separates you from your business. So what sort of legal liability do I have? The third thing that you want to think about is, in the future, do I want partners or not? If I don't want partners, an S corporation might be a perfect setup for you. Even if you want partners, but they're going to be individuals that are here in the US and they're not going to be funds or other people, an S corporation might be for you. That's all stuff that you're thinking about as you're thinking about the S corporation. The next thing you want to think about is, how creative, how flexible do I want to get with my partners? If you want different levels of distribution, if you want different levels of preference, if you want different voting rights, if you want different, a lot of flexibility, you're either going to go that C Corp way, or if you want that pass-through tax status, you're going to go the LLC route. All of these things are then around flexibility. And finally, you want to think about taxes. Are you doing something that's going to generate income or maybe even a loss in the early years? Because if so, you really want to think about that pass-through tax status and not having that double layer of tax. Because as you're moving forward, again, even if they're losses, you want to be able to take them against maybe other income and offset other income you might have on your tax returns. If, however, you're looking at going through and really raising money from a fund, and you're in it for the long haul, and this is a high-tech startup, you're really going to hit it out of the park, a C Corp may be the option for you. These are all the things to consider and factors to consider as we go through this. And we've just hit about the 25, 30-minute mark. So what I want to do now here is start to open it up for some questions, some answers. But ultimately, what I hope you heard out of today was, there's 4 different forms of entities, 5 different forms of entities that you can choose, less the self-proprietor one. And hopefully you got some to-dos on how to actually go about selecting one for you. If you'd like further information on this stuff, you're welcome to contact us at the email address on the screen, info@tgg-accounting.com. We're happy to help you start to think about this. Again, you do need an attorney to set these things up. You still need a tax CPA to file your taxes on an annual basis. And by the way, there's no difference other than the sole proprietorship. There's no difference in any of the annual filing fees for California for any of these. So we don't need to worry about that. All right. So now I think I'm going to open it up for questions and comments. We've got some, I know, so we've got some good time here. So I think we take this here and I stop sharing. Is that right, Hannah?
Yeah, you're good. So I can start asking the questions. And then for everyone who's on, feel free to click on that Q&A box on the bottom of your screen and type in your questions in there. The chat box is locked, so you cannot type your questions in there. So our first question is, I want to register a business where 2 partners are US citizens and 1 is not. What would be the right entity type?
Okay, so again, the first thing to do is just start to eliminate ones. It's not a sole proprietorship. The second thing is, it's probably not a limited partnership unless you'd want to think about what you were doing. If the general partner can have liability, then a limited partnership could work there. So that really kind of leads me to one of 2 things. It's either going to be an LLC or a C Corp, because remember, it can't be an S corporation because one of the partners or one of the shareholders is from outside of the country. So it can't be an S Corp. So the real question now is, do you want that tax pass-through tax status, which is going to be in that LLC? And that's going to give you a lot of flexibility again around who's going to control it, what sort of distributions are going to be made, what sort of profit distributions are going to be made, and who's going to have control. Or do you just want it in a C Corp where it's the majority of the shareholders control? Or you can set up different classes of stock and you don't care about that taxability. So it's probably going to be between the LLC and the C Corp. And I would say the tipping point is going to be whether or not you care about that pass-through tax status.
Okay, great. Next question is, does that mean an LLC cannot own an S Corp?
Yes, short answer. An S Corp could own an LLC, but an LLC cannot own an S Corp because in an S Corp, the only owners that you can have are individuals, and they have to be U.S. domestic individuals as well.
Can you elaborate more on cascading entities and the benefits of both?
Let's see, cascading entities and the benefits of both. I'm not sure I understand that question, Hannah.
Jason, if you can elaborate more in the Q&A box, I can come back to your question.
Yeah, just not sure if what they mean is having entities owned by other entities, sort of like a hub and spoke model where you have like a holding company and then maybe other entities off of that, or if they're talking about the different entity types. So would love to.
He said exactly. He means LLC owning a C Corp, for instance.
Got it. Okay. So if you're thinking about some kind of a hub and spoke model, you want to think about a couple of different things. We're getting into a little bit more advanced stuff. But if you have like a holding company, you could set up a holding company that's an LLC and then have multiple LLCs around this. This is a very typical situation for real estate holding companies, where you set up one LLC, you raise a bunch of money into that LLC, and then you go out and set up separate LLCs for each one of the properties, and you own those, again, with the holding company. So the holding company is where you have different members or different shareholders, and then each of the satellite LLCs might own just the property, but is 100% owned by the holding company. So that's a very typical model there. The other thing that you might want to think about is some sort of a consulting model. So we've advised folks in the past about having maybe a C corporation for, maybe there's licensing purposes, or you're working with the government and you need to have a certain entity type, or you're working with even foreign governments, you need to have a certain entity type. So maybe you need a C corporation, but you don't want that C corporation not to have pass-through tax status. What you can do is you can set up a separate LLC over here or a separate S corporation, depending on who could own it, and you can pay the management fees over here. So you can take the profits from your C corp, instead of having to pay them all out of salary, you can pay them over here as a consulting fee or a management fee to your management LLC or your management S corp, and now get that pass-through tax status, but still be able to do everything that you need to do with the C corp, whether it's licensure or requirements from the government, anything like that.
Next question is, why do some VCs avoid investing in LLCs?
What I would tell you is that these VCs are looking at funds. And so it's an economics issue. If they're a pass-through entity and the venture capital firms invest in an LLC, they're going to get reports on how much that entity is losing. And actually, if they own it, they have to absorb those losses immediately. Venture capital investors are sort of all or nothing investors. They know that they're going to invest in 50 things and 40 of them are going to fail. What they want to make sure of, though, is they're not getting losses on a consistent basis. They want 100% loss or nothing. And most of the companies that they're going to invest in are not going to be profitable in the first few years. And so venture capital firms, who are generally funded by big funds, big banks, things like foreign governments, all of that sort of stuff, want to invest for the most part in a C corporation, because then it's all or nothing. Either we win and we go public, or we lose and we don't. Or we win and we sell, or we lose and we don't. But it's not in the middle. So a lot of venture capital firms will shy away from investing in LLCs. And obviously, like we said before, they cannot invest in an S corp because they're an entity and they're not an individual. So that's typically why a venture capital firm would prefer to invest in a C corp. But that's not always the case. In many cases, what we're suggesting for budding entrepreneurs, new businesses that are just starting up, is to set yourself up in an LLC. And then when you go out to get investment, tell them, look, I'm open to changing my investment, my corporate mix. If you want to go with a C corp, we can very quickly shift to a C corporation without any real tax consequences, without any real problems. So oftentimes you might want to start as an LLC so that if you're the individual, you can take the tax benefits in year one or the first 6 months of it, and then maybe switch to a C corp if a venture capital firm is dictating that that's the way they want to invest.
What's the advantage of forming a corporation in another state versus California? Does it matter where you do business?
Got it. This is a great question, and it's something that there's a lot of misinformation about this subject. Excuse me. I've heard so many people tell me, I'm going to incorporate in Nevada so I don't have to pay income tax in California. And that's just garbage. It's just flat wrong. You pay taxes where you do business. The best example I have of this is NBA players. When an NBA player plays in different states, they actually have to file tax returns in every arena they play in. Every state they play in, they have to file a tax return because they're paying tax in those states because that's where they earned it. So it doesn't matter whether you file or form your entity in Nevada or Idaho or Alaska or Delaware, not for tax purposes. It makes no difference. Now, let me take a step back. There are some differences when it comes to privacy. A lot of people will tell you a Delaware entity is the best entity for overall privacy. So if you file your LLC papers, you want to file it in Delaware. What I have found in my experience is that if you go out and get sued, anyone who's suing you has a right to subpoena any information they can get. And unfortunately, there isn't a lot of privacy out there. So I haven't found it to be incredibly effective, but I will say that there is different privacy laws in different states. Just don't think you're going to pay anything different in tax, because you're still going to have to pay the California Secretary of State filing fee every single year. You're still going to have to pay California taxes if you're doing business in California.
I would like to start a single person consulting company. I heard that I am legally liable even if I have an S Corp or LLC. Is that correct?
Okay, so yes and no. So let's talk about this, because if you're a person starting a consulting firm, I would suggest that you probably go with an S corporation, and that's going to give you the best tax status. It's also going to give you the liability protection of a C corporation, so that if the company does something, the company has liability. But if you're a consultant and an individual consultant and you give bad consulting advice or you do something illegal, not just bad consulting advice, because really that's still probably inside of the corporation. But if you personally go out and do something that's illegal or outside of the bounds of what would be corporate liability, yes, you could face personal liability. But otherwise, no. The whole idea behind a corporation is that you want to set that up so that the corporation has the liability and you don't have the personal liability, even if you're just a single shingle, one person doing consulting.
What are the advantages of a C Corp?
Sorry, that was a great question.
So sorry. Next one. What are the advantages of a C Corp, i.e. taxes and liability?
Okay, so there is no advantage from a liability standpoint. As I said, a C corporation and an S corporation are identical. In fact, they file the exact same corporate documents. They file the exact same tax return, except for the S election of the S Corp that allows the income to pass through to the shareholders so that the shareholders get what's called a K-1 and file their own tax returns with pass-through income. So there is zero difference when it comes to liability. There is a big difference when it comes to tax, because a C corporation, again, is going to pay tax at the corporate level. That's a 21% level, plus the state income tax. In addition to that, when you get money out of a C Corp, you have to pay dividend tax on it, because the only way to get money out of the C Corp to the shareholders is through dividends, loans, or payroll. Loans have to be paid back. Payroll is full of payroll taxes and everything else, and income taxes. So the only real way to get money out of a C corporation is dividends. So a C corporation is going to typically have slightly more tax than an S corporation is, because the C corporation has the double taxation effect.
Are there special considerations for setting up a manufacturing company?
That's an interesting question. I don't believe there are special considerations, given that it's just manufacturing. What I think you need to consider is that a manufacturing firm has a lot of liability, both employee liability, because you've got manufacturing things running, and so there's a risk of workers' comp and injuries and things like that, but also because you might have product liability. And so you really want to think through what is going to give us the best liability protection. So I would throw sole proprietorship out the window. Definitely do not want to be a manufacturer in a sole proprietorship. I would probably throw a limited partnership out the window, because then the general partner is going to have full liability for anything that happens in that manufacturing business. That leaves you with an LLC, an S Corp, or a C corporation, which all three, as long as you retain all of the proper corporate formalities and you're doing all of the minutes and you're meeting annually and you're keeping up with all the tax returns and you've got a separate bank account and you're following all of these things, your liability is going to be equal in a C Corp, S Corp, and an LLC.
How easy or difficult is it to transition from an LLC to a C Corp?
It's fairly easy at the startup stage. If you've had an LLC for a number of years, it can be difficult, because in an LLC, you're taxed on the income that flows through, but you also have to maintain something called a capital account. And this is a tax, really just a tax discussion. And so sometimes you might have a negative capital account or a positive capital account, and that could cause some tax issues as you move to a C Corp. But if you're an LLC for a short period of time, what I was suggesting before, you're going to get venture capital investment, you're not going to have the same level of issues. And so, so it's not very hard to do it, but it's actually much more difficult to go from a C corporation to an LLC than it is to go from an LLC to a C corporation.
Is there some benefit to establishing a tech company as a Delaware corporation? I reside in California and earn my income and pay taxes in California. Your previous response makes sense. Is there a separate rule for tech companies?
There's no separate rule for tech companies. It's a good question. Most tech companies do actually register in Delaware, and that's primarily for the privacy reasons. It's an extra couple $100 a month. Believe it or not, I have an LLC that's registered in Delaware as well. And so it doesn't really do anything other than it's supposed to give you some extra privacy protection. I personally have not found that to be the case, but there's no, again, I would really lean on an expert in Delaware privacy laws, but you're not going to get any benefit as far as taxation goes if you're doing business in California. It's the same as filing, and you still have to file with the Secretary of State. You still have to file your tax return in California. You still pay California taxes. None of that changes just because you have your entity organized in the state of Delaware.
If an online company based in California and provides services virtually, would it still be tax liable for out-of-state clients?
All right, so this is an interesting question, and one that is a pretty big gray area. This is something that Amazon, for example, has been fighting for years and years and years, because obviously they're doing business in all 50 states. And what a lot of these other states have said is, if you're doing business in my state, you owe me state income taxes. And I will tell you, technically, that's probably correct. So, for example, if we had consultants in Ohio and my consultants were doing business in Ohio, I probably have to file an Ohio tax return, allocate whatever income came through those people in Ohio to Ohio, and allocate the rest of it to California. But what I want you to think about is, this might be a big benefit for you. This might be a big opportunity for you. If you're doing business in other states and then you can pay income tax in other states, chances are those states are lower tax states than California. We're one of the highest in the nation. Next to New York, we're probably the highest in the nation. So maybe it makes sense for you. Work with your tax CPA, really think through, should we file in other states? Because also, the other thing is, if you're filing in other states, there's a cost to filing a tax return in every state. So just think that through, because in theory, you're supposed to apportion your income to where you earn it. And that's the key phrase there, is where have you earned it?
What is the difference between LLP and an LP?
Virtually nothing. An LLP is a limited liability partnership, LLC is a limited liability company, and an LP is a limited partnership. As far as the taxation goes, an LP and an LLP are going to be identical, and an LLC is slightly different, just because in an LLC we call the shareholders members, in an LP we call the shareholders partners. In an LP and an LLP, you're going to have a general partner and a limited partner. And in LLCs, you're going to have managing members and non-managing members. But remember, in the LLC, the non-managing members have no liability, and neither do the managing members, who still have all the control and who have all the say.
I have an LLC and planning on selling licensing agreement on my propriety process. Is it doable in an LLC structure?
Absolutely. It's very doable in an LLC structure. The only thing that I would want you to think about is, if you're setting up a licensing deal, it sounds like if you have multiple shareholders, an LLC might be the way to go, or if you have foreign shareholders. Otherwise, you might want to consider it as an S Corp. Because remember, in California, this LLC has this gross receipts tax. So regardless of whether you make any profit on it, you're going to end up, if you're in licensing, you're going to have revenue. So regardless of whether you make a profit on that, you're going to owe tax in California if you're an LLC. Whereas as in an S Corp, you're only going to pay tax if you actually have profits. And so those are a couple of considerations when you're thinking about setting up either an LLC or an S Corp in a licensing deal.
You mentioned that there is a lot of flexibility in using an LLC to make agreements with fellow members. What creative types of profit sharing and other types of agreements have you seen in LLCs?
This is a great question. This is as creative as you want to be. It truly is. It's unbelievable. So I was just I am working on a transaction right now for a client of ours who is trying to bring in investment for their business. They are coming in with about $100 million valuation and trying to figure out how we're going to do this. And what we've done in this LLC structure is an individual's coming in and putting money in, and they're going to get, just by way of example, they're going to get the first $1 million worth of profits. After that, for the next $1 million worth of profits, it's going to be split 75% to the investor, 25% to the existing shareholders. After that, the next 5 million of profits is going to be split 50-50. And after that, it's going to be pro rata. And in this particular case, they're putting in $5 million and they're getting a 5% interest. So even though they're only getting a 5% equity interest in the business, they're taking 100% of the first profits, 75% of the second tranche, and 50% of the third before they get into their pro rata. So they're getting a rate of return before they get back into their sort of typical ownership structure. So in an LLC, very similar to a C corporation, you can get as creative as you want. It can get really crazy. And the good side of that is if you have investors, you can really start to align risk with payments and payment terms. And that'll give you a lot more flexibility in attracting capital.
I'm looking to form a LLC tech company registered in California. I am expecting some seed funding, could be a person or a company. Would I still what is the benefit of LLC versus another entity type?
So great, again, another good question. The benefit of the LLC is the pass-through taxation, because in this particular case, you're a tech company, you're going to take on multiple investors, and probably an investor, from a fund. You're going to want to make sure that you're either an LLC or a C corporation. And the LLC benefit versus the C corporation, again, is the pass-through tax status. So if that's important to your investor, you'll want to go that direction. If it's not, you'll want to think about maybe a C corporation.
If I choose an entity type today, what is the ability to change it later? i.e. LLC today, convert to a C Corp in 5 years from now.
So if you're an LLC today and you want to convert to a C Corp later, that's not that difficult. Okay, you do need a good tax lawyer, you do need a good tax CPA, and you need to plan it out at least a year in advance so that you make sure you don't get any tax traps that might be sitting there. If you're going from a C corporation, however, to an LLC, that can be much more difficult. And you really want to think about how you're doing this. So entity structure matters. It really does matter. And if you want to think about it, like I said, the first thing you want to think about is the vision for the organization. Are you going to have multiple shareholders in the future? And is it possible that some of them could be funds or foreign investors, things like that? Because if so, you're really limiting yourself to either the LLC or the C corporation. If not, an S corporation is probably the best situation overall for most businesses that aren't going to be doing that. So the first thing to think about is, what is your vision? What is your business plan for the future? And where are you headed? And then start to sort of outline it from there.
How can you get money out of an LLC elected as a sole proprietor that is not profits without commingling funds? Okay,
so if an LLC has a single shareholder, which again is called a single member LLC, because a member in a shareholder in an LLC is called a member. So if you have what's called a single member LLC, it's treated as a non-entity for tax purposes, meaning you're going to file all of your taxes on Schedule C of your tax return, just as if you were a sole proprietorship. But you do get the legal liability protections of an LLC. The problem is you're getting pass-through tax status, and then all of your income is getting hit on your Schedule C with all of those payroll taxes. So you really want to be mindful as you're setting up those single member LLCs that you're really just setting up a sole proprietorship with a little bit of a legal bubble around you. But it's truly just a sole proprietorship with that legal liability protection of an LLC.
Have you ever used or seen the use of profit sharing for non-owner officers to attract/keep talent?
Absolutely. Absolutely. We do it in our firm. And I think a profit sharing type plan works great. Now there's two different types. You can do what's called a qualified profit sharing plan, which is similar to an add-on to a 401k, where it's tax deductible to the business and non-taxable to the employee when they get it, but it's like an IRA or a 401k that it's taxable when they take it out as income. That is what's called a qualified plan and a qualified profit sharing plan. And in order to do those, you're really going to set up a percentage that you're going to give to your employees based on their salary, based on the profits that you make. But don't feel limited to those. If you're going to set up kind of some sort of profit sharing plan, you can also set up a profit sharing plan that says, hey, if we make $100, I'm going to give $20 to my employees and I'm going to allocate it 1, 2, 3, 4. No rules necessarily other than what you want. And you can set up incentive-based plans. I'm a huge believer on setting job descriptions by outcome. And when people hit those outcomes and when the company as a whole succeeds, When the team is really winning, you want to share those winnings with everybody around you. And so a profit sharing plan setup is incredibly valuable for any number of different organizations to motivate employees to all work together and achieve the mission of the organization.
Is husband and wife owners considered single member LLC?
Not if they own it separately and file separate tax returns.
All right.
Yes.
Sorry, go ahead.
No, that's it. Pretty simple.
All right, those are all the questions I have. Oh, wait, another one just popped up. This is a follow-up to the question before last, I believe. For tax reasons, there is no difference since all income is taxed. I can't write myself a check to get out the money I injected into the company, as that would be commingling funds. Is there a way to take back some of my cash injection into the LLC and get around the taxes?
So this is something that a lot of people get confused about. When you put money into an LLC, it's called a contribution. When you take money out of LLCs, it's called a distribution. When the LLC earns money, it's called income. That income gets passed through to the members. Those are all three different things. So you can put $100 into an LLC, take $100 out, and have no tax consequences whatsoever. The tax consequences come when you put the $100 in, you take that $100, you make $1,000 of income, you have $1,000 of income to you. You can take that full $1,000 out. You could also take $1,000 plus the 100 you originally took out. You would only be taxed on the income. You're not taxed on the distribution, you're taxed on the income that is generated inside of the organization. So that's confusing for a lot of folks, and reasonably confusing. It's understandable. So distributions are not taxable, contributions are not taxable, income is taxable. Distributions and contributions are money in, distributions are money out. The taxable portion is all the income that happens inside of the entity that gets passed through to you as a shareholder, or in this case, LLC, as a member on your K-1.
Can a single member LLC complete the 8832 form?
I don't know forms well enough to tell you what the 8832 form is. If they can expand on that, I might be able to answer the question.
Yeah, Anonymous, that's the name. If you could please expand on that, that'd be great. And then we can get you an answer.
Yeah, I apologize. I'm not a compliance CPA, so I don't deal in form numbers that much.
If I can for you as we wait. The form to be taxed as an S Corp.
Sorry, so can you repeat the whole question, Hannah, one more time?
Yes. Can a single member LLC complete the form to be taxed as an S Corp?
No, so a single member LLC by definition is going to end up filing on your Schedule C. So it wouldn't have any impact to file as an S Corp, because S corporations create K-1s, and a single member LLC is not going to create a K-1.
Are contributions and distributions also allowed for partnerships and sole props?
Partnerships, yes. Sole proprietorships, as I showed you that slide that had just sort of money in the pocket. The sole proprietorship is just taking money from one pocket to the other, so you don't need to worry about it. But in a partnership, contributions and distributions are accounted for that exact same way as they are in an LLC, as I described before.
Can you please differentiate LLC and S Corp?
Yeah, so the primary difference between an LLC and an S corporation is going to be flexibility and type of shareholders. So in an S corporation, remember, you can only have up to 100 shareholders, and they have to be US residents, US domestic citizens, and they can't have to be individuals. They can't be entities. In an LLC, you have all kinds of flexibility. You can have any kind of owners you want. You can have any of the sort of investors you want, funds, people from outside of the US, inside of the US, all the rest of that stuff. And in an S corporation, you can only have one class of stock. So you can't have some that get that waterfall that I was talking about before, some that get preferred dividends and other ones that don't. Everybody has to get a pro rata share of distributions. In an S corporation, you can have voting and non-voting, but you can only have one class of economic stock. In an LLC, you can have anything. You can make it as creative as you want, different kinds of shareholders, all that stuff. But ultimately, they're taxed identically and they have the exact same liability protection.
Which category does contribution and distribution show on a balance sheet?
So on a balance sheet for a S corporation, LLC, or partnership, you are actually going to have a line item that is in your equity section of your balance sheet that shows contributions or distributions. And one big mistake that I see is not reconciling that on an annual basis. So a contribution and distribution account is only good for 12 months. It's just like a P&L. And at the end of the year, it should reconcile and be at zero. So if you're starting on January 1st, you should have a zero in your contributions or distributions account. And then, by the way, if you put money in or take money out, you would know it, because what you do is you reconcile all of that to retained earnings. So whatever you took out in the year or whatever you put in the year goes to retained earnings on your balance sheet at the end of the year when you do a balance sheet reconciliation of your equity.
If my LLC has no profit, only income that has been distributed to partners, would I be paying tax on income or profit?
I'm not sure what the difference is, because profit and income, I think, are the same thing. At least in my definition, they're the same thing. So if somebody wanted to expand on that question, but profit and income, in my mind, are the same thing. Profit is what profit/income is synonymous.
Abish, if you would like to expand on that. If not, those are the only questions that we have. But I'll give her a few seconds to see if she'll or he will.
Yeah, because I think, again, in a pass-through entity, you are taxed on the profit or the income that entity generates and your percentage ownership of it.
All right. In the meantime, we have another question. Does contribution different from owner's equity?
Yes and no. So contributions and distributions are one component that makes up total owner's equity. If you can imagine, on a balance sheet, you have the stuff you own, those are your assets, minus the stuff you owe, gets your total owner's equity. But what about distributions? What if you took money out? If you took money out, that's obviously going to lower your owner's equity. So that's where they work together.
In terms of paying members in an LLC, can you talk about what guaranteed payments are and why they are used?
Yeah, this is a really tricky, weird thing. I don't know why the tax law is set up this way, but if you are an active participant and an owner in an LLC, you cannot receive a salary. Instead, you receive something called a guaranteed payment. What is a guaranteed payment? It's the same as salary. The only difference is that you are taking on all the payroll taxes. So that's what I said before is, if you're an active participant and an owner in an LLC, you're actually paying all the payroll taxes on your quote unquote salary. So when you hear guaranteed payment, think salary. Just know that a guaranteed payment is a salary for LLCs, whereas in an S Corp, C Corp, or partnership, you actually take a salary.
Referring back to the previous question, couldn't contributions in one year potentially carry over to a distribution in another year?
They do, but they don't carry over. You reconcile them in one year to retained earnings. And then if you take a distribution in the next year, then again, at the end of that year, you would reconcile that to retained earnings. So that your distributions and contributions account is always zero starting on January 1st or at the beginning of your new year.
All right, if no one has any more questions. Oh wait, every time I say that, another one just pops up. They know. What is the best structure for a license to manufacture in the USA where the license is signed/granted with a European entity?
Okay, so you're going to make sure I understand this. You're holding a license that is owned by the license is from a European entity or owned by I'll try to answer this question either way. I think I understood it, but maybe I could have gotten it wrong.
Signed/granted with a European entity.
Granted by the European entity. Okay, so really it's anything. You could have an S corporation or a C corporation, as long as that European entity is not an owner in your new entity. It could be an S corporation or an LLC. Either one would be great, because you probably are going to want the tax pass-through status, and you're going to want the liability protection that either one of those provides. And so you really want to think, are you going to take on other shareholders that are going to be non-US citizens? If so, you want to think LLC. If you're going to take on funding from a big firm, a venture capital firm that wants you to go public, maybe the C corporation is the right answer. But typically it's going to be somewhere between an S corp if it's just you, or just a couple of shareholders that are local, or it could be an LLC if you want those, again, the myriad of different flexibilities around other shareholders, or if you have a fund that wants to take you public, it could be a C corp.
When you talked about guaranteed payment and the owner pays all the payroll taxes, does that mean they are paying 2 times Social Security contributions, which is normally paid half by corporation and half by the employee?
That's exactly what it means. Yeah, that's exactly what it means, because in guaranteed payments, you don't withhold any taxes. All the taxes are the responsibility of the recipient. And so that is exactly what it means.
All right. I think this is it. Nope, I'm
Nope.
wrong. If S Corp is only for US citizens, what special benefits does it offer versus LLC?
What it offers is two things, and they're just tax related. The first one is that you don't have a gross receipts tax in an S corporation. You're paying a net profits tax. So that's a benefit. And then the second benefit is what we were just talking about. Again, you can take a salary in an S corporation and the corporation actually pays half of your payroll taxes. Now, if you own 100% of the S corp and you own 100% of the LLC, that whole payroll tax argument is kind of moot because you're paying yourself either way. But if you have multiple shareholders, or if you're not interested in paying yourself as big of a salary, you can take the S corporation and take distributions out of the S corporation that won't be subject to payroll taxes.
Is forgiven loan liable or liability or equity?
Is forgiven loan liability or equity? So if you put I'm gonna take this a couple different ways. If somebody gives you a loan to your business and that loan is forgiven, that loan goes from a liability to income. It actually turns into income and it's taxable income. If that loan was from the shareholder and that loan was forgiven, it's still taxable income, but you might as well distribute it out to the shareholder if it's a single owner type of an entity. So forgiveness of debt is always going to be income to the entity that is being forgiven.
How could you open a social enterprise business that is looking to supply technology to charity organizations in underdeveloped countries?
So I love the mission. And I think, again, as I said at the very beginning of this, I believe that every business should have a social mission and should be doing something good for the world and should be having a benefit for the world because that's why people will pay you for it. But in this particular case, it's really the same as I would look at any other entity selection. It's you're going to get the same liability protection. You're not going to be a sole proprietorship. So you're talking about a partnership, probably not a limited partnership, because if you're doing a lot of this work, there could be liability by going internationally and doing things like that. So it's probably an LLC, S Corp, or a C Corp. And again, you're just going to want to think through what kind of different shareholder owners are we going to have? And really, what is the overall liability? What is the long-term vision for the organization so that you're thoughtful about funding and all the rest of that stuff. But whether you're a socially beneficial enterprise or not, whether you're a nonprofit or not, which we didn't talk about nonprofit entities, which are 501c3 corporations, your organization has to be profitable. At some point in time, profitable entities are what continue to be going entities.
How could you, sorry, that was the same question. Can you repeat how tax will be paid for in an LLC?
Taxes in an LLC so if you have a multi-member LLC, if a single member LLC, again, you're paying your taxes on your Schedule C. Multiple members, which means multiple owners, they're going to get what's called a K1. And that K1 comes through and it shows your percentage of income and how much income you get. And that's what you put on your Schedule E of your tax return if you're the owner.
What is the maximum amount I can donate that is treated as a tax deduction?
I would check with your CPA because it's dependent on your income levels. But in a corporation, you want tax deductions are treated the same as they are for individuals. Well, in anything other than a C corporation. In a C corporation, you're going to want to think about whether it's a marketing contribution or whether it's a true charitable contribution. And again, I would go to your tax CPA to try to figure out what kind of a deduction you can get.
All right, that's all of them. I promise.
Well, thank you so much. Thank you so much, Matt. That was a great rapid fire Q&A. We had a lot of folks chiming in there. So thank you so much. And you can see the information at tggaccounting.com. Feel free to contact TGG for any other assistance or extra questions if you think of them later. Thanks everyone for joining us for today's webinar, especially thanks Matt and TGG Accounting for your support and partnership. Again, all the everyone who's listening will receive the recording and slides tomorrow via email. We'll also plan to present additional webinars on topics of interest to tech startups in the coming weeks. And we have one more installment in this series next week, same time, same channel with Joe Johnston coming back. If you need immediate assistance with anything accounting related, please contact TGG. If you need assistance with loans or funding or anything related to small business, feel free to contact the SBDC. You can see in the chat, our hotline is 1-800-616-7232. And to get one-on-one consulting with your tech or life science business, you can contact us at sbdctech.org/contact or .com. Either one works. So if you have any other questions, please email Hannah at hkhaled@fullerton.edu. We're here to help you and your business make it through this crisis. So thank you so much for joining us. Stay safe and healthy.
Thanks, everybody.